Welcome to Investors Guide. You're watching ET Now. Thank you so much for tuning in. On this show, we're going to spend the next half an hour answering as many of your questions as we can. And we'll try and solve as many problems that you have with personal finance. The idea is to make it as simple as possible so you can use the advice and you can get on top of your money by the end of the week. On the show this week, we'll first figure out how the pay commission ruling will change the money in your bank account and what you should do with that extra money. In our product review, we look at the Reliance Vision fund and we'll help investors save enough to buy homes over the next 15 years. All right, let me bring in Narendra Kumar, the CEO of Value Research. Narendra, big announcement that came in for government employees. They're going to have a happy new year. A massive bonanza of 23.5% hike across the board for all central government employees. The minimum pay has been hiked from about 6,000 to about 18,000. That's double. We know that this will be implemented from the 1st of January next year. The difference between this pay commission and the previous ones is that there'll be no arrears. So there'll be no lump sum amount to hit anybody's account, but they all can look forward to higher pay starting January. And this also applies for those people who are drawing pensions at this point from the government as well. 47 lakh central government employees will benefit. 52 lakh pensioners will benefit across the board. Obviously, if I know I'm getting a pay hike starting January, I'm going to start making plans for that money. But there should be a structure with which we approach this pay hike. And I want this advice right now to go out to any central government employee or pensioner who's listening at this point, Narendra. Should they start first by paying off loans, paying off credit cards, or should they be investing that money? What's your advice for someone who's looking forward to this higher paycheck starting January?
They may not have the option of, repaying their loan or anything because one is not getting an arrear. But accumulating your savings in an optimized manner so that you can prepay 1 or 2 years ahead of time. And it's very important that people, they plan for their savings with incremental investment. So, there are simple steps to that. One is resist your temptation to spend that money. That is the strongest, and that is the biggest risk that you have. That a big increase in your income, and many of your expenses will just bloat to fit, to consume all that income, that increased income. So if you can plan your investments, and if you are working, if you are able to manage your expenses in your current income, look at it as a bonanza which can be used to accumulate into something sizable. And then a year or two down the line, you will have enough savings to square up any of your outstanding or any of your debt, any of your large debt.
Well, Narendra, we have, of course, a pecking order with which we want people to handle their debt. The normal first option that people think of is to pay off their home loan because that's the one that worries them the most. But I would prefer it if they started with credit card first, then personal, then pay off any auto loan, and finally arrive at the home loan. So if I have a 23.5% bump up in my salary, should I just be increasing the EMI on my home loan once I've paid off all the other loans? Or should I invest some of that money and increase the EMI on the rest of it?
If you're a disciplined investor who can stick to an equity fund or 1 or 2 equity fund, then stick to that. It doesn't make sense to prepay that. But if you are not a saver, if you are not an investor, then that should be the logical thing. But the other point which everybody should consider is that increased income will also translate into increased taxes, and plan for it.
All right, so increased taxes is something that you have to plan for. What I'm going to do is on your screen are the equity funds that we recommend on the show as well as the tax saving funds that we recommend on the show. Narendra, a quick word of advice for the pensioners as well who are going to receive a higher pension starting, the 1st of January. How should they be dealing with that extra liquidity?
Pensioners, I think, it's entirely a matter of looking at central government employees are very lucky that they are entitled to the central government health scheme, which takes care of their old age health care as well in a reasonable way. And apart from that, there's unlikely to be so. They should look at it as a bonanza. And if you're thinking in terms of leaving a larger state, then the same approach should be followed, that invest in equity because you're unlikely to consume all that money.
Right, invest in equity. I'm going to give you a quick roundup of the advice that Narendra has just given us. Remember, and this is from my point of view as well, if you are going to see a higher income starting January, give yourself at least 6 months to get used to that higher income. Or maybe even 3 months, 6 months might be a long period to not touch that income, just so your family budget sort of adjusts. But like Narendra said, before you make plans on spending that money, and there'll be a temptation to do that right now, start, of course, by paying off all of your loans. Pay off any credit card, personal loan, auto loan first before you reach your home loans. And when it comes to your home loans, it always makes more sense right now to invest a portion of your money in equity for the long term instead of using all of it to pay off the home loan. And if you're a senior citizen, there are tax savers on your screen right now that you can use. These are our conservative tax savers that Narendra has recommended. You can write them down. And if you're watching this show and you have any questions at all about the announcements from the Pay Commission, feel free to write to us. Our email ID is at the bottom of your screen. It'll be our pleasure to help you with any problems that you have. Let's move on now to our first question on the show. Our portfolio question comes in from a 29-year-old NRI, Narendra. Sachin Kulkarni has written to us on our Facebook page. Now, he has short-term and long-term goals. He'd like to build a corpus of 75 to 80 lakh rupees for an apartment that he wants to buy in Bangalore. He also wants to have a 2 crore rupee term cover that he wants to buy online and a retirement corpus of 5 crore rupees. Just to tackle his term cover, I'm not sure if NRIs are allowed to buy term covers online. You might want to check that. There's also, depending on which country you live in right now, Sachin, there are restrictions on whether or not you can have an Indian term cover. So check all of that, because you haven't told us which country you're writing in from. Check all of that and then let us know. Narendra, he sent us a list of his financial details. He saves 2.5 lakh rupees every month, 7.5 lakh rupees going into the PPF every year. 45,000 rupees he's paying as premium on an LIC policy that's 8 years old, 38 lakh rupees in fixed deposits, and 21,500 a month he's been investing in mutual funds. Now, we'll go to a selection of mutual funds in a bit, but I'm a little worried about how much money is sitting in PPF, LIC, fixed deposit. All of these are debt investments for a 29-year-old. He'd do far better focusing his attention on equity, wouldn't he?
Yeah, I think he needs to completely redo his plan and his priority. He should work towards, he has enough money in the fixed deposit, so he should think in terms of how much deposit he should have so that any emergency or even an extreme emergency is taken care of. Rest of the money, he has a sizable accumulation in PPF, and PPF, one should look at PPF as a 8.7% yielding or a fixed income yielding long-term recurring deposit. So from that standpoint, I think every investor should seriously reconsider their investment in SIP, their investment in PPF, and consider even a balanced fund. I'm sure will be able to maximize your return. Simply in return of a disciplined approach to investment and taking your averaging your investments over 15-year period, which most investors do with their PPF account. So that's another thing to reconsider. So work on your term plan, get your health insurance, have the emergency fund, and just keep investing in a conservative, even our stable growth portfolio.
Narendra, if you have some time, we'll take a look at his mutual funds as well. He has a Franklin India Smaller Companies Fund, iProve Value Discovery, IDFC Premier Equity. So he's obviously picking funds very carefully based on our advice. He's also got Prima Plus, Birla Sun Life MNC, SBI Pharma, Quantum Long Term, and Mirai Asset Emerging Blue Chip. Now, off his list, the things that I'm worried about are the MNC fund and the Pharma fund to begin with. Can he do away with those two funds?
Yes, ideally he should do away with those funds, and rest of the funds look very carefully chosen and reasonably good funds. So the broad principle, I think any investment should be based on some key principle, which is have diversification, average your investment, and invest through the lean times. And these three things, and adequate diversification. This actually violates that rule, having a sector fund.
All right, so this is the advice you're getting right now. You need to drop the Pharma fund for sure. The MNC fund you can hold on to, but it's not the smartest choice at this point. The rest of your funds, Narendra says, you can continue to hold. Now remember, the big piece of advice that you're getting at this point is to not use so many debt investments. If you have a lot of money in debt, start moving most of it to equity. Narendra, he wants to know if he should be using a retirement plan to achieve his retirement goals, and I'm assuming by retirement plan he means maybe one of the plans that come from an insurance company, maybe a ULIP or a traditional plan. We really advise him against doing that. Can he just use these same mutual funds for his retirement goal?
Yes, he should clearly, in fact, increasing his allocation to these funds itself will translate into a retirement plan if he is going to hold it and continue his investment till his retirement.
All right, so the funds that you have will suit you just fine for your retirement as well. Just increase your allocation and you should be okay. And you know that over the years, if you have any more questions, you can get back in touch with us. Welcome back. You're watching Investor's Guide on ET now. Thank you for staying with us. It's now time for our product review, and this week we're looking at a Reliance fund, the Reliance Vision fund. Avan will give you the numbers and then we can come back and talk about it. Avan.
Thanks, Faye. This week we take a look at one of the multi-cap funds, the Reliance Vision fund. The fund's performance has been average over the long term, but how does its performance look in recent times? Let's take a closer look at its performance chart over the last 5 years. Now, the fund's performance has been particularly disappointing over the last 5 years, with the fund underperforming its benchmark and the category both during the bull and the bear phases of the market. In fact, the fund has lost nearly 3% in the last 1 year. Even the fund's performance over the long term has not been promising. Is it time then for a sell call on this fund? Let's find out. With that, it's back to you, Faye.
Narendra, Reliance Vision as a fund has been rather unimpressive. It's also had a tough year. It's lost about 5% this year. It's not keeping up with the category average. It just, given the fact that it is a multi-cap fund and there are so many better options within that category, would you give this fund a sell call at this point?
Yes, I think, this fund has not been able to make a case for itself for a long time now. Except for its initial 5-6 years, this fund has really struggled. And even, look at the last 7-8 years. It has, 4 of the 8 years, it has not been able to beat its own benchmark. And beating benchmark, if not, and the years in which it has been, only 2014 was a very, good year for this fund. Otherwise, even when it's able to, beat the benchmark by a very modest margin. And looking at all the peers, I think, this fund just doesn't stack up.
Well, currently the fund has about a little over 3,000 crore rupees in assets under management. Narendra giving this fund a sell call. So if you're holding this fund in your portfolio, go back, take a look at it. It might be time to get out of this fund. Narendra, equity multi-cap is a very exciting space to watch at this point. For those of our viewers who are actually exiting Reliance Vision at this, based on your advice, what fund would you recommend to them instead?
If I have to recommend some, I would say ICICI Pru Dynamic Fund or Franklin Prima Plus or Mirai Asset Opportunity Fund.
All right, those 3 funds are on your screen right now. Narendra is saying that Reliance Vision really has not made a case for itself in a very, very long time. So if you're still holding that fund, it might be time to give up and move on. 3 alternatives are on your screen. Narendra, it's rated 2-star on Value Research. What would you rate it for Investor's Guide for viewers?
Yeah, I think, it has, looking at the portfolio and looking at the way it is configured right now, it doesn't look all that bad. It's one is really surprised to see that why this fund has not been able to generate return. So it's not a horrible fund, so I will slot it at 2-star fund.
2 stars there for the Reliance Vision fund on Investor's Guide. A quick reminder that Narendra has put a sell call on that fund. It's very rare that we have a sell call on this show. But it's time to move on from this fund. It's also time to move on to our hold or sell segment. This is an interesting question, Narendra. 50-year-old PANKAJ Agarwal has written in. He's looking to build a corpus of 7 to 8 lakh rupees for his daughter's wedding in the next 5 to 6 years. That's not a very long period of time. Also, he's been making lump sum investments into mutual funds. Now, he sent us a list of the funds he's invested in. We don't know the dates in which these investments went in. But he has HDFC equity with 44,000 rupees. But before we go into his list, Narendra, I want to first step back and actually examine his entire strategy of putting lump sum investments into funds. And it's all piecemeal. 7,000 in one fund, 11,000 in another. Sometimes the investment has gone up to 20 or 25,000 rupees or 70,000 rupees. It just seems like he needs an overhaul in his entire strategy.
There are 2 ways of looking at his investment strategy. One is that if he is not a regular salary earner and once in a while he gets some income in which he is able to put to work by way of these investments, then it's fine. But if he is a normal salary earner, then he should be onto a steady plan that will actually keep his anxiety in check. He will be on to a methodical plan. He will be able to average his investment, and he will not get anxious about his investments as and when things are not very favorable. But it is better to have these investments than not have them in the first place. So that's the other way. That's the other side of it, which I might feel very happy about.
But Narendra, even if he's not salaried and he's investing lump sum amounts, there is a need to streamline his portfolio, because I don't want him to buy a new fund every time he has a lump sum to invest. What he needs to do is pick a few funds and continue to accumulate in those funds every time he comes across some amount of liquidity. What is the maximum or the ideal number of funds someone like him should hold?
I think 4 to 6 fund is good enough, and but it entirely depends depends on the scale. If you are investing, something like 2,500 rupees a month, then I think one fund will be enough. And if you're a taxpayer, then one balanced fund will be enough for that investment if you're a first-time investor. And that does the job very well.
If we take a look at his funds, Narendra, I'll do this as a rapid fire because we're running out of time, and you can tell him which of these he should be holding or selling so we can streamline this portfolio. HDFC Equity, hold on to that one. It seems ideal for his goal.
Yes, this is a struggling fund, but he should still hold on to this fund.
ICICI Prudential Focus Blue Chip Equity is the next on his list, Narendra. Hold on to this one as well?
Yes, given his time frame of 5 to 6 years, it's a large cap fund, it's a good fund, he should hold it.
SBI Magnum Equity and SBI Magnum Global are the next on his list. Does he need both of them?
Both are very different funds, and I think, given his time frame, he should be on a little conservative, so he can do without the global fund. Though SBI Magnum Global is an excellent mid-cap fund, but he should not have that. He should just focus on, he should be into more mainstream fund, and Magnum Equity is one.
Sundaram Select Mid-Cap is the next on his list, Narendra. I'm a little worried about the fact that he only has a 5-year horizon on his goal. A mid-cap fund might be a little aggressive for a 5-year horizon.
Yes, it will be aggressive, and it might be also a good time to exit such a fund, because mid-cap funds have done very well. The mid-cap segment has done extremely well over the last 1.5 years. Despite the struggle of the market, these are the only funds which have been able to generate reasonable returns for investors even in the last 1.5 years. So, a good time to exit and not suited for his time frame.
Reliance Tax Saver is the next on his list. Of course, it would depend on the time that he invested, whether or not he can take the money out. But it's a good tax saver. Hold on to it.
It's a good tax saver, but going by his time frame, and because Reliance Tax Saver is an aggressive tax saver, it will be the most rewarding fund. But it will also be disappointing depending on the time you take out, because this is among the tax saving fund which has the highest allocation to small cap. So look at it as a small cap fund with a 3-year lock-in.
Right, small cap fund with a 3-year lock-in. Last 2 funds on his list, Tata Dividend Yield and UTI Dividend Yield, Narendra. Hold on to both of them.
They are extremely disappointing fund, and it might be a turnaround might be around the corner. So one would have done all the waiting. So I would say that it might be very inappropriate. They are well managed fund, and they have stuck to their strategy, and the strategy hasn't worked in the last few years. So hold on to this.
Welcome back. You're watching Investors Guide in ET Now. Thank you for staying with us. This week we're going to answer all of your questions on asset allocation with Vishal Kapoor, who joins us on the show. Vishal, such a pleasure to have you on the show. First question comes in from 35-year-old Jasmeet, who's written in. She tells us she has an investment horizon of 20 years. That's always nice to hear. And she sent us a list of her financial details. 6.5 lakh rupees in equity, 5 lakh rupees in fixed deposits, and 1 lakh rupee in mutual funds. We'd like her to sort of increase that allocation. She's also invested largely in debt funds so far. She wants to now begin putting aside 30,000 rupees every month in 3 or 4 funds. And she's come to the right place. Vishal, would you recommend how she should go about doing this? So first, she needs to find out how to pick those funds and what those 3 or 4 funds are going to be.
The one thing that we don't know enough about is what is your risk profile. And, for the portfolio that you have, I think it is well suited. It's quite balanced between fixed income and equity. It's more fixed income right now. But if you do have a 20-year time horizon, then you could take a bit more risk. So one suggestion we would make is that instead of a lot of equity, you could be a bit more aggressive on the allocation for for equity mutual funds. So from an aggressive equity mutual fund investing standpoint, a couple of funds that we would recommend. The first one would be a Franklin Templeton Primer Plus fund. the Kotak Select Focus, as well as the Birla Frontline Equity Fund. These are again in the large cap, proven track record and good quality over a long period of time. You may also want to add a bit of mid cap flavor. So the SBI Magnum would be a good choice over there to add a bit of mid cap to your overall portfolio.
50-year-old R.K. Nair has written in from the Middle East. He tells us he has a time horizon of only 5 years and 50 lakh rupees to put aside in mutual funds. Vishal, 5 years is a short period to go aggressive into equity. What would you recommend he does?
If it is a moderate profile of portfolio that you want, you don't want to take too much risk because 5 years is a good time horizon but not very long. You may want to consider a balance between equity and fixed income. So if I were to recommend a few names, then you could look at the Franklin Templeton Prima Plus, the Kotak Select Focus, the Birla Frontline Equity as part of the equity allocations for yourself. On the fixed income side, you could look at the Tata Short-Term Bond Fund, the Birla Bond Fund. You could look at the UTI Dynamic Fund as well. So this could be a strategy. Specific funds, of course, would follow only after we've done the risk profiling. So that would be a good place to start.
Last question comes in from Manish, who wants to build a corpus to buy a home in the next 15 years. Manish, this is absolutely the right place to be if you want to buy a home. He tells us he's been investing in the SBI Pharma Mutual Fund from November 2014. He also has SBI Blue Chip in his portfolio. He wants to know what you'd recommend. Vishal, now for someone with such a specific goal and such an emotional goal, I don't know if he should be going with a pharma fund or with a fund that depends on one particular sector. What sort of funds would you recommend he uses instead?
We noticed that both the funds that you've chosen are with the same fund house. So it's a concentrated risk on that fund house. One of them is a sectoral pick. So you've got to be able to monitor these funds very carefully, especially if you have a very clear goal like building a corpus for your house in this case. So another thing you could consider is to diversify across a few fund houses, both in terms of styles as well as in terms of the types of the overall selection of market cap that they may have. So that's one. The second is that I'm hoping that you work with an advisor to work through the maths on how much you will need for that house, and that calculation and that assumption is critical because while you do have a long-term time frame for saving, we want to ensure that the saving is actually adding up to that amount of corpus you will need to buy a house. But again, if you're employed, then should there be a shortfall, you do have the option of a home loan as well should you want to. So those are the two things we would watch out for, but again, good to see that you've started.
All right, that's a wrap on Investors Guide. Vishal, thank you so much for joining us. But for those of you who want to buy homes at some point in the future, we have a brand new offering from this group. Magic Bricks Now is our new channel and it focuses entirely on real estate and property. So anything you want with property, just tune in to that channel. It's on your screen right now. You can also access us on our website, mbnow.in. Tune in and you'll see a live view of the channel and all of the videos, and you can interact with us on that channel as well. But thanks for watching Investors Guide. We're going to be here week after week to answer your questions. Email ID is at the bottom of your screen. Stay tuned.